Good morning, everybody. My name is Kevin Uphill. I'm the chairman of Avondale Corporate. Welcome to our webinar, Private Equity Myth versus Reality. Now, we put this together because we're increasingly doing private equity deals. For those of you who know Avondale Corporate, we help people buy and sell companies in the emerging mid-market space. So typically 1 million to 50 million enterprise value, companies with 10 to 200 people. And obviously, many of you will be familiar with the trade deal, and we certainly need to explore that when we're looking at exit strategies. But we're increasingly seeing private equity playing a part both in exit strategy, but also investment. So we think there's a lot of misconceptions about how that works. And today we're hoping to spend, say, 50 minutes exploring some of those, some of the aspects of private equity and some of those perhaps misconceptions to help people understand it better and to perhaps embrace the opportunity more. Please ask questions as we go. You've got the Q&A questions section at the top. No hands up, please. I can't cope with that. But please ask questions and heckle as you go. Would be really helpful. We'll also be recording the webinar so that you can forward it to colleagues. So about 50 minutes, some questions. I'll talk to you for sort of 10 to 20 minutes to set the scene. And then we're joined today by two private equity practitioners and specialists who will also be giving you their perspective on what's happening out there, some of the pros and cons, and the real-time situation. So, you know, again, fire questions at them. I'm not going to go through their bios. I will introduce them in a second, but I won't do the bios. Please look online if you want to know more about their background. So what is private equity and why explore it when selling your business? Well, as we know, conventional wisdom is the trade deal is best. They will always pay top dollar, particularly in an auction circumstance. But if you can see here at the bottom corner, we need to examine it because, in fact, there's over £2.3 trillion worth of private equity money in Europe looking for a home, which is a much deeper pocket than most trade have access to. So it's becoming increasingly important and increasingly attractive in the market. Private equity is literally money looking for a yield. And you know why private equity in smaller cap companies or non-quoted companies, essentially it's because there's a limited yield elsewhere in other asset classes, whether that's stock markets or property, and people are therefore looking for higher yields, which you can secure by investing in private companies. And that's very much the trend, which again is why it's such an important part of the marketplace. We're joined today by David from Shelverton and Guy from Rockpool, and I won't go through all their bios, but I will just say Rockpool has been going for about 6 years. They invest very heavily in the private company space. They've got over 80 portfolio companies. Some are household names. Hartley Botanic, Primrose were ones I knew, but that's perhaps I'm a keen gardener, so they stood out to me. Shelverton, slightly more unusual private equity in that they are also more interested in long-term holds or patient capital, as it's known, and we'll let David explain that a little bit more later. So, trade sale versus private equity. We need to examine that. People come to us, they say, I want to sell my business. They don't say, I want to take private equity typically, but increasingly we're looking at that option for people in that circumstance. Of course, the pros of the trade deal, if you can create that, we need motivation, and you can find the right buyer with economies of scale, synergy, shareholder value. In an auction situation, they will typically win that bid. The con of that is you lose independence. It's not necessarily your baby. Often the business will change dramatically within the merger or buyout. But also there's no opportunity to go on a journey in terms of the future growth of the business. So all the work you've done creating a foundation for your business that makes it attractive to a trade buyer, the upside broadly they will benefit from. I mean, there may be some earn-out mechanisms, but broadly they will benefit from. Whereas typically with private equity, our sellers are retaining a stake or only partially selling and then going on that journey to enjoy that uplift. And fundamentally, that's the difference in terms of private equity as to how you can, match trade values. The con, management and entrepreneurs, private equity is still very different in terms of private ownership versus being owned by an institution. Management and entrepreneurs can find it difficult to operate under that new ownership. Financial buyers, very spreadsheet driven, for example, and it can create tension. We'll look at that a bit more later, but that's a sort of backdrop. So private equity is a proven exit strategy. And you see here on the left, capital is the fuel that fires up growth. Many private companies are held back due to lack of capital. So they've grown to 60 or 30 or 100 people. They don't have the bank support to drive growth into triple-digit growth numbers, and they start to plateau. They also plateau around the skill set of the entrepreneur. So if you like, and using the analogy I've got here, business is kind of the land bank for private equity, and they are the property developers. So what they're looking to do is buy companies and typically triple or more the value of that over 3 to 5+ years. Now, as I say, there's some models which are more patient than that, and David would be a good example of that, so he will explain that later. But what you're doing when you're looking at a private equity sale, you're bringing those two circles together, business and private equity investment. You're putting capital into the business, and that is then breaking the plateau that the business may be facing for the next levels of growth. And how does that translate? Well, I've got an example here, and I mean, if any of you have been to our talks before, some of you might have seen this slide. But this is showing typical multiple valuation drivers on a price earnings ratio. And you can see on the bottom, we've got sort of profit in EBITDA, earnings before interest, tax, depreciation, and amortization. And then on the left-hand side, you can see we've got multiple ratios. Key trend is the bigger the profits, the bigger the multiple. Obviously, this is a general slide. It's not sector specific. There are also sector peculiarities. You see at the top there, the strategic buyer, the darker brown color, typically will pay more, although they are always looking at alternative options, organic growth, and or competing with you. So private equity are often getting close to matching those strategic trade deals. But a key point which you'll need to remember later, the bigger the profits, the bigger the multiple. So that is a key part of this equation. And we need to examine why. And ultimately, it's because of the middle point here, which is that private equity are looking to triple their value or more in the life cycle of their ownership. And one of the key ways they do that is through multiple arbitrage. So multiple arbitrage, you buy at a multiple of 5 or 6, you exit at a multiple of 10 times profit. And that's part of the alchemy of doing a deal. And you do that by uplifting the EBITDA or the PBIT, the adjusted profits of the business. But they also do other things. It's not all about scale. Private equity are very, very focused. And one of the criticisms that we see of, if you like, the emerging mid-market that we're dealing with, this 1 to 50 million value, is often managing directors lack focus. They try too many initiatives and don't do them, any of them well enough. They're too spread. Whereas private equity will tend to spend a lot more time researching what the strategy for the business will be, getting the management team really focused, saying no more often, segmenting clients, and only running key focus within that business. And that could be very powerful catalyst in terms of growth. The other thing, of course, they bring is capital. That creates opportunity to do mergers and acquisitions. An awful lot of private equity specialise in what's called a buy and build and then sell strategy. And we did one recently, actually. We were involved in, we sold a business called NDSR to Linnaeus Group, which was backed by Sovereign. It was a referral veterinary hospital. Sovereign started with 120 staff. They grew that business from 1 to 87 sites, from 120 staff to 1,400 over the 4 years they owned it, and they had a 700% increase in EBITDA. That is a classic buy and build strategy, and they absolutely nailed the exit on that with a really good growth exit. So that ultimately, remember I said private equity is kind of like the property developers of the business world. They're not looking to be buy-to-let landlords generally. They're looking to buy and then later sell on the company at triple plus value growth. They will also invest in new products, new territories, often again more expertise at export markets or establishing sales presence. And we did a transaction last year with private equity, and that's a key part of the strategy there. We're looking to set up a sales division in America, and they will look at those sorts of elements. An area not necessarily spoken about, but also really, really important, also a tension point. Private equity typically, when they hold and own a company, have a better prospect to attract better talent. Emerging mid-market businesses, of course, are exciting for our employees and staff because they all count. But the high quality employees tend to want to join bigger companies because there is a faster growth story and more career opportunity. Well, within private equity, literally by nature of being part of a private equity business, they have that scope and opportunity far more so than an independent business. So they can attract better talent. Now, that's good and bad in some respects because, and I call it cultural to commercial, but often it's actually one of the key tension areas behind sales. You sell into private equity and or trade, and the culture changes. And with private equity, we call it cultural to commercial. So cultural is where the business is a village. Everybody helps each other. Roles and responsibilities aren't very clear. We're all nice to each other. We all support each other's deficiencies. And actually, that's typically most emerging mid-market businesses. Whereas commercial is more like the city, 360-degree appraisals, bottom 10% out every year. Roles and responsibilities very clear. Held accountable. If you can't do it, you're out. Now, private equity very much sits on that commercial side, and that can be a real catalyst for growth, but it can cause significant tension in the existing team, and it's important to understand that. So do you remember I said earlier, and we had that chart where we were looking at multiples going up as profit went up? That's really key, and we mentioned multiple arbitrage, but most of the private equity transactions we're doing have a form of either investment or elevator deal to the transaction. And this is an example of a private equity transaction playing out. You can see here on the left the initial transaction. The orange is the fund held by the private equity. So in this case, they have bought 70%, maybe 80%, and the white is the seller choosing to retain a stake. Now, we are doing 100% sales to private equity as well, so it's not necessarily essential they retain a stake, but in many cases it's encouraged. So in this case, they've chosen to retain 20-25%. So that means that on this side, the value is bought out at 65-70% on day one, and the owners are de-risking and securing capital in that initial sale, which is important because private equity new ownership, it's not proven. So there's a material de-risk which motivates sellers to look at this on day one in realizing the capital value of their business. But why would they retain a stake? Well, because we can elevate it over 5 years, and potentially, if you see here, we might be in a position on the fifth bar here to match the original de-risk on their exit. So second bite of the cherry may be as much and or more than the initial de-risk in terms of valuation. So although the valuation on day one might be slightly lower than the perfect strategic trade deal, the valuation on day 5, i.e. the 5th year on that exit, should be materially greater as the business has gone on a journey of growth, whether that's organic growth. Typically it's a combination of organic growth, acquisitions, and multiple arbitrage fueling that triple digit valuation. So rollover or retaining a stake is really important to the private equity equation. So one of the things that we're being asked at the moment, and again this is also relevant with trade deals, of course, COVID. What can we say about COVID? I'm looking forward to wearing my mask tomorrow, guys. Hopefully that will help us get going a bit more. Obviously, we've got a recession in the backdrop. Fundamentally, that means we need to do more deals to create bigger companies with more economies of scale. Private equity can have a real role in that, as can trade. And we do see that there are too many businesses in fragmented sectors without those economies of scale, and doing M&A is a really important growth factor for the economy, particularly when you've got slow growth and slow organic growth. If you're growing a business at 10 to 15% a year, you don't need to do acquisitions necessarily. But if you've got slow organic growth, then acquisitions is a real method to growth. Of course, private equity isn't just necessarily an initial platform business that they're buying. We may also need to explore trade deals that they've done in the past and who they are then looking to buy themselves. So again, we need to understand how they think and how they work. Private equity is very much open for business. We'll hear from David and Guy on that in a second, but their business is deploying capital. They don't make money unless they deploy capital. The 2.3 trillion already raised, it needs to be deployed. So the doors are very much open for business. I see actually we've had a question coming about debt, and we are seeing more equity deals being done where they are looking to use their fund to do the acquisition and entirely equity back it and then fill in later with debt. That's because it's quicker, and I think in the COVID era people want fast transactions. We're also seeing deals being done on what we call the EBITDA model. We had a webinar on this a few weeks back, if you want to see it. But EBITDA is earnings before interest, tax, depreciation. DAC is now the COVID model, post-COVID. So what we're looking at is businesses being sold on the real-time recurring revenue, and also what value can be ascertained against the real-time numbers. And that's particularly important for any sort of sale, private equity or trade. You need to be in a position where you've got real-time numbers and you're able to demonstrate the strength of the lockdown U or V shape, whichever's happening in your business. Most we're seeing a bit of a U, if we're honest, probably mirroring the economy. Being able to demonstrate the speed of lockdown recovery and how that then plugs into forecasts. Other changes of COVID, we've seen an increase in interest in technology due diligence. I think there's a realization that the virtual world is more critical than ever. So the whole data protection arena, the whole ability to work remotely, technology platforms are becoming more important. So historically, money's been spent on commercial and legal due diligence, financial, but now we're seeing a trend into that technology due diligence. And of course, we are seeing deals being done, private equity and trade, linked to that recovery post COVID. So there are, and I'm going to get the guys to talk in a minute. You've probably heard enough from me. We've got a couple more questions coming as well, so we'll handle those when we get the guys chatting. But there is, of course, a question for sellers and or your clients if you're an advisor. And obviously one benefit of the trade deal is it can be immediate exit, whereas private equity very often not so immediate. But within that, what we're seeing is a lot more choice for sellers. You know, the historic method was private equity wanted to retain the entrepreneur. They were expected to run the business and they were locked in. Increasingly flexibility to move to other roles. There's a recognition entrepreneurs aren't necessarily the best MD operators to grow businesses. The skill set to go from 1 to 100 people from startup is very different to the skill set from going from 100 to 1,400 people. So the opportunity to step back, become a chairman, retain a stake, be a passive investor. Quite a few of our transactions recently within private equity, we've agreed that the MD stays for a year or so whilst they find and recruit their replacement. That means they get to enjoy the de-risk so they can improve their golf handicap. Certainly that's what our client Mira did with that NDSR deal. She's been learning the cello and improving the golf handicap whilst watching the retained stake increase. But we would employ a professional managing director, sit on the board, track our investments. So there are all sorts of options. So this question, should I stay or should I go, even more important post-COVID, because we've had a tough ride and we're going to have a tough ride, can be answered in that flexibility that you know, it's open and it can be discussed. And maybe you do want to stay to be the CEO, maybe you don't, and there are options there. Maybe you do want to retain a stake, maybe you don't, and there are options there. So it really is a journey. One of the things we are seeing as to why people want to retain a stake, remember earlier I said there's private equity is really interested in private companies because there's no yield in other asset classes. Same applies to sellers. You know, you sell your business, you have a large lump sum capital through the de-risk or the total sale. What are you going to do with it? You know, the history of buying a holiday home, probably not so easy today with the whole COVID travel problems. And also, where are you going to get a yield? Whereas actually retaining a stake in your own company can generate the best yield available. So that's about being aware of the options. Let's look at the tension points and then we'll get the guys to talk. So I'm really near shutting up and we'll get to the questions in a second. Big tension points, cultural to commercial, change of team can be a real challenge. And increasingly reporting, we're often, it's not, by the way, it's not just private equity. We sold a business to an American trade buyer and the sellers came back to us 6 months ago and said, oh my God, you have never seen this level of reporting. That is just the more corporate world. SMEs tend to, you know, not have the same level of dashboard as corporates. Private equity, they love a spreadsheet. I always remember when we had one meeting with a private equity guy with my client, and I said to him, could you explain the private equity model? And he said, what, without a spreadsheet? And I thought, do you know what, he's nailed it down the line. Absolutely, absolutely. Often that means that the finance team are bolstered, which is important, but again can create some tensions. Board governance normally improved dramatically, regular board meetings and absolutely focused. You know, if the entrepreneur stays the CEO, no flying kites. You can't build your strategy around the best salesman in front of you, I'm afraid. You've got to stick to the rules of where you've said the business plan is going to be and be held accountable to sticking to it. So it becomes perhaps slightly less entrepreneurial and more corporate and more focused. Sometimes, therefore, the feeling of the startup spirit can be lost. Not always, but sometimes it can. And you have that tension point around the old guard and the new watch. And if we're pragmatic about it, not all the team will make that transition. So let's examine what is it really like working with private equity, and should you explore this route to sell your business? We're going to hear from Guy and David. David, if I can ask you to turn your microphones on and put yourself on screen, that would be lovely. There's Guy, thank you. David, can we put your camera on? That'd be great.
Yep.
Thank you very much for joining, gentlemen.
Pleasure.
In conversation, so this is where we get to be like Waldorf and Statler. Do you remember the old men from the Muppets? Guys, you're too young, you won't remember them, but we get to chew the fat, we get to grumble. We will answer some of the questions that we've got coming in as well. But any reactions to my talk? What do you think I got right? What do you think I got wrong? What struck you?
Oh, that might take half an hour if we go through all that. But
half an hour.
Think
too long. Okay.
I think you've absolutely. I think the tension points are interesting because I think you've hit the nail on the head. You know, when people are looking at trade versus private equity, they are very different options. I'd say one of the things to add to the comments is that often it can be about lifestyle of the founder and the management team and what they want to do next. We work with some management teams who are mid to late 40s. They're not ready to retire. They want to grow their business, for another 10 years. So doing a trade exit doesn't necessarily work for them because they might join the trade business for 1 or 2 years, but then essentially they'd potentially move on. So one point I'd add is it does kind of depend where you are as a seller on your kind of career aspirations about whether to go with PE and try and push on to the next stage, or whether to retire and sell to a trade company.
I think that's absolutely right. I mean, I always talk about, and it's a very big shame really, but Kate Spade, she sold her business and never really found purpose afterwards with a real struggle and end result on that. An outright sale, the idea of just golf and playing the cello is good, but it isn't right for everybody. And actually, there is a form of grief that comes from letting go of your baby, and private equity can resolve that. So I think that's an important point with younger management teams. We've had some questions in, and David, this might be a good one for you. But I mentioned private equity put debt in. Are you doing that with your transactions, or is that you're doing all equity? What are you looking at when you're looking at investment?
Well, generally, most of the money will go in terms of investor debt, so not third-party debt. So, in other words, we're not going to engage a bank or other provider of third-party funding with all the issues that has with bank covenants and compliance with that. So, generally, it'll be in investor debt. It'll have a fairly high coupon, let's say 8%, so probably more expensive than third-party debt. But at the same token, it's in the investor's gift to waive or deferred interest or principal repayments should the circumstances dictate. So, for example, if cash is required for a small acquisition or to reinvest in capital equipment, it may well lead to deferral of the investor debt repayment. And in one of our portfolio companies at the moment, because of the uncertainty of COVID, the investor debt principal repayments has been suspended for the time being. It didn't need to be, but out of caution because of the uncertainty in the environment. So that's one of the advantages of using, if you like, our model, and I'm sure it's common with lots of others, is that you don't have generally third-party debt.
I suppose we should talk about that. I've said how you guys are viewing uncertainty in the environment. You've got capital, you need to deploy it. But am I right?
In our particular case, we don't actually have a fund. We raise money for investment by investment basis. So while we're representing one particular investor at the moment, who's got reasonable access to funds, he's not under any pressure to invest. So we'll only invest if the right opportunity presents itself.
And that's important because a lot of the funds we deal with, I mentioned Sovereign earlier, they will raise a fund, I think their last fund, they got 200 million raised. So they have to deploy that capital. Guy, you also are syndicated per deal, aren't you? So, are you finding investor appetite from your bank of investors or?
We are. I mean, I think absolutely our deal flow will be down this year compared to where we were in the previous years. And obviously looking at sectors like retail, hospitality, travel, all of these sectors, not many PE houses are going to be jumping 2 feet into them, as you'd expect. So deal flow is certainly down, but I think from the last financial crisis, there are a number of mid-market houses which continue to invest through the financial crisis and actually ended up doing incredibly well. And I think there's a slight FOMO effect of the last round where a lot of PE houses are continuing to invest through the crisis. I know that we're certainly looking at about 3 transactions at the moment. And whereas a typical year we'd invest probably into 6 or 7 companies, this year we might invest in 4 or 5. So it's definitely going to be down, but I think private equity is definitely learning from the last financial crisis and will want to pick, resilient assets that they can put funds into.
And as you mentioned there, sort of, fear of missing out. I mean, valid, but with the uncertainty at the moment, I mean, how the hell do you value companies, guys? I mean, I've got my views on how that's done, and we've agreed, I think, 4 deals since the sort of lockdown easing. So, everyone's tackling it slightly differently. What are your houses doing?
David, do you want to go first?
Okay. Well, we're just looking at the underlying trends, the historical trends, and then the impact of COVID and the lockdown on the companies, and we're trying to make an assessment of whether that is an accurate and sustainable view of future prospects. Obviously, we had looking at one investment recently where it didn't go forward because our valuation was quite a bit lower than the vendors, and the reason for that was this high exposure to automotive and aerospace, so 2 sectors which are particularly badly affected. So we're quite nervous in those sectors where you can just see from the information in the public domain that the recovery program is going to be in those sectors is going to take some considerable time. Obviously, if it's a company supplying into the food industry, for example, consumables into the food industry, that's probably pretty resilient, and we wouldn't, our valuations wouldn't be hugely affected by the current environment, and it'd be an attractive proposition.
Yeah, I mean, have PE multiples dropped? I mean, we would make an argument almost the opposite because there's less quality, and the companies that are survivor companies are going to go up in value, not down, because there's more people that want them. But maybe I'm an optimist.
There's definitely been increased multiples in some industries. When looking at high recurring revenue software companies, there's definitely been a flight towards them from a lot of private equity houses who are looking to deploy without the risk of COVID impact. I think just to add to David's point on looking at historic performance of the business, we're using an increasing number of mechanisms in our deal structures to try and account for COVID. The first of which can be deferred consideration or an earnout. So we're seeing earnouts in the vast majority of deals that we're doing now, whereas actually before we weren't a big user of the earnout mechanism. So obviously, if a business was doing 2 million EBITDA last year and is doing 1 million EBITDA this year, and they expect to go back to 2 million EBITDA, we can give them obviously day one value for the 1 million EBITDA, but then they have to prove that they can get back to the 2 million EBITDA to unlock the full valuation of the business. So that's one mechanism, and then ratchets, based on performance. So that's more on the back end. If the management team believe they can get to 5 million EBITDA, achieving that will unlock an additional pot of equity for management or the sellers.
And I think that sort of links back to that blend of elevator deals, so not even necessarily retaining a stake, but structuring the de-risk with an earn-out as well. And really that's the art of deal making, isn't it? I mean, I think, we've got a client that absolutely refuses to take any form of earn-out and fundamentally can't sell his business because of that, because, yet the sector is to die for. And, we have told him repeatedly that if you structure it correctly, you can protect the risks of earn-out. I think there's a lot of myths around, if you take an earn-out, you've got to discount the value of that. Structured correctly, our experience is the vast majority of earn-outs are achieved. You guys, what's your view of it? Do you see that?
Well, some vendors are very, very skeptical about deferred consideration and earn-outs because they're very wary, and basically it comes back to a lack of trust. We've had comments like people saying to us that any deferred consideration elements they're going to write off from day one.
Yeah.
Now,
which is a lawyer's mindset, isn't it?
It is difficult, and one of the points you made in the course of your presentation, Kevin, was the fact that there is this fundamental conflict between the sort of new owners and the original vendors or management, and the issue is that you've got to try and build trust in what is a very stressful process. The whole sale and purchase process is fraught with issues and tensions which can erode trust. So, one of the key things we're looking for is can we invest in a company where we believe in the management team and or vendor if the vendor's staying around.
I think it's a lovely point you make there, David. I absolutely agree with the point. Trust is so central to this, and this is called myth versus reality. But unfortunately, private equity 15, 20 years ago got a pretty bad reputation in terms of that trust. You're either equal to bankers or certainly considered the same category, guys. How do you get that trust into the story? Because it's just not, again, my experience, completely unfounded. I mean, there are some you need to protect against, but the vast majority of private equity, highly professional, looking for alignment, deferred payments, earnouts, yes, complex, but all easy to protect, open conversations, resolvable. Why do vendors have that misconception? How do you build that trust? Because the industry hasn't really succeeded, has it?
Yeah, it's a great question. I mean, I think a lot of people think of, when they hear about private equity, they think of KKR or BlackRock or some of the big players who do, debt for equity swaps and are out there doing some really aggressive stuff. And obviously, in the lower bid market, at least, that's absolutely not the case. We are often the first institution that comes in to invest in a business, and for that reason, our investments are very much built on chemistry with the management team and the founders, and building trust through that initial conversation is absolutely crucial in effectively enabling us to win deals. If you can't build trust quickly with the team, then if they're talking to 3 other private equity houses, you're not going to win the deal. So really having a strong track record, having references, a lot of people now are asking to speak to other CEOs in our portfolio and ask, how did Rockpool behave during the transaction? Did they honour the heads terms that they went through? Did they chip on the way through? And how are they behaving on the board? And we've had it on a number of occasions now in the last few months where vendors are looking to speak to CEOs in our portfolio, and that is a great way to do it.
Yeah. And I would sort of, I suppose, mirror. I think, again, a lot of entrepreneurs, founders, they start a business because they like control. And I would sort of make a point that control is, in fact, an illusion. If we've learned anything from COVID, that's the one thing we must have learned. And actually, private equity is about the next level of teamwork. So I think the conversation should be expanded beyond trust to teamwork. If you get that alignment, this is teamwork to make even better companies. Businesses independently owned will only get so far on bank debt. It's very difficult to scale up from off bank debt in a headwind, which is what we've got in front of us. So I think it's trust and teamwork, sort of part of that answer.
Yeah, and actually having a chairman, having an independent chairman is incredibly helpful as well, in terms of, often PE houses will recommend chairman candidates who are used to PE and have seen PE structures before, but having a chairman who can both support the management team and see both sides of the fence, they can play a really crucial role in making sure that the teamwork is there.
That's good. And I suppose we ought to examine, because we mentioned this 3 to 5 year hold, which I know is certainly Rockpool very much your model. But David, you're a bit more patient than that. What's the thinking there? What's your longer term hold concept?
Well, I think it really comes from sort of the start point of Chelverton. The principal behind Chelverton, David Horner, has basically always been a long investor, both in the quoted funds, the unit trusts and the investment trust, and also in some of the unquoted investments he's made. So, for example, if you look at one of our related companies, SEPS PLC, you will see that a number of the companies have been there for some time. And basically, our philosophy is that there is fundamental value in investing in smaller companies. Often, as you already pointed out, because the entry multiple is lower than for larger companies. And if you invest behind those companies and grow them over time, you're going to get a very respectable return. It won't match some of the returns expected from larger PE houses, for example, when a lot of the models are based on moving or selling the investment on in 3 to 5 years. But some of the investors we represent have farming estates, mixed farming estates, and they probably have them for hundreds of years. So
they're waiting for it to grow. They're happy to plant a small hedge and end up with a big one eventually. Yeah. They're not London gardeners. How do we put that? Yeah.
Well, the other thing is they in some cases they're looking to diversify their interests, because the yield on farming estates, for example, is absolutely rubbish. Capital value is fantastic, but the yield is dreadful. Whereas you can get potentially a very sensible yield from a business investment, and that is important. So it's the running yield as well as the ultimate capital value.
We should talk about that with the rollover point. So, I'm saying, look, sellers, we can get you a trade deal, you've got all your money, then you're going to have to figure out what you're going to do. Or, do a private equity deal, go on a journey. Let's see if we can improve the value as we go. But of course, that relies on the business being sold at some point at that uplifted value. And in that journey, private equity are typically charging fees, interest rate on their money going in. Question here from one of our delegates, what are you seeing in terms of interest rates and repayment terms? So I've seen somewhere penal rates have been put in turnaround situations. So, and certainly, I've seen some of the fees from private equity. They are quite eye-watering. I say to my clients, any rollover, don't think of it as a dividend play. It's a capital play. You're unlikely to see a dividend. Yes, you've enjoyed that. This is all about what that state's going to be worth in 5 years, not any dividend yield because of the fees. What are you seeing in terms of fees and interest on money going in?
Yeah, I think on yeah, go on, David.
Okay. Our typical model is the interest on any investor debt and or rolled over vendor loans, anything 6 to 8% is not especially is not penal. Clearly, if it was a turnaround situation, it would be a completely different matter. But then you'd probably roll up the interest anyway, just because of the cash constraints of the business. Fees are, personally, I think are reasonably modest, but I would say that, wouldn't I? So that's our experience.
Management fees of 30 to 50k a year. You know, is that typical? I mean, you know, on a smaller deal, a sub say £10 million. You know,
yeah, I'd say it's. I think, you know, this is all about the value add that that PE are going to bring to the business model. I think to cover the couple of points in there, we've definitely seen rollover equity, you know, where a founder rolls over 20% into the structure, and they make more from the 20% on exit than they do on the original 80%. So on the second deal, they make a lot more money. And really the value add that the Rockpool, well, not just Rockpool, but the PE house is trying to bring there is essentially, particularly for the Rockpool model, our goal is to take your business from 1 to 2 million EBITDA to 4 to 5 million EBITDA. And there's multiple arbitrage, which is something which is obviously in the graph that Kevin has shown. But there's also an incredibly, there's a lot of hard work that goes into the professionalization of businesses to make sure they're ready for sale at that 4 or 5 million EBITDA. And that is really what you can get from a private equity house, which is we're selling portfolio companies of ours to the likes of Sovereign and Flexion, you know, all the big mid-market, and they will expect a certain level of management account, board governance, integration of acquisitions. There's a lot that they expect when they're going to pay full whack for a 5 million EBITDA business. And really preparation for sale starts the day after our transaction, and that's where you can get the big value.
Yeah, I think that's really important. You know, I mean, and then there's also, again, that discipline is part of them. There's an alignment between that sale preparation and the growth, because again, it's part of that, what I called commercial professionalism, isn't it, within the next level.
Absolutely. And in terms of interest rates, you know, I think a lot of PE houses, some will charge it in cash, others will roll it, and as Dave said, it can be anywhere from 6%. We've seen it in other PE funds up at 12%. But there was one question on when to take third-party debt, because it's a lot cheaper than the PE fund debt, and that's a great question. And I think the answer to that is actually on size. So banks really like to lend to businesses making at least 2 million EBITDA, from what we find. And there's kind of these cliffs of the debt getting cheaper and cheaper as you get up to 5 million EBITDA and above. So we will often refinance our loan notes at the higher interest. We'll refinance with the cheaper senior debt as soon as we feel the business is large enough and stable enough to take a third-party bank.
Interesting, it's good. So, I mean, a sort of slightly more challenging question for you guys. I mean, really, it's almost how good a salespeople are you? But all PE firms say they're great to work with and they add value. I sit in a lot of meetings with both trade and private equity, and I have to say all the pictures are good. It's difficult to tell who actually delivers. You know, why do you add value? Where are you better in your respective opinions? This is your chance to run each of your sales pitch, if you like.
Go on, David, you go first.
Well, that's not I would say my strong suit is sales pitches. Yeah, look, at the end of the day, the key thing is about the relationships and the people the vendor is going to have to work with going forward, and the management team. And essentially, in my view, it comes down to that on both sides. And you know, from our perspective, you know, the key question we're asking is, can we do business with this vendor and management team? And they should be asking exactly the same question back again. Therefore, how do you test that? Because you're at that point in those initial meetings when you're trying to build trust and confidence, both parties are in sales mode. So I think Guy made a very good point previously, is that, you know, do take up references. References are often offered. We offer references often people don't take them, which is always a real surprise to me that they don't, because obviously that the proof of the pudding is in the eating. Obviously, again, the cynics amongst us might say that the references will only be the good ones. So what happens when something goes pear-shaped? Things go pear-shaped. We're always happy to talk about that, and the reason why, and often the reason why is a management issue, which, if we're the investor, we've not properly assessed.
Okay, thank you, David. And Guy, do you want to have a crack at that one?
Yeah, absolutely. Look, I think David's point is absolutely right. The number one piece to this puzzle is chemistry between the private equity house and the management team. I think a lot of people, will go into a deal and think, okay, this is all about numbers. Who's going to pay me, an extra $1 million for the transaction? But actually, you then have to sit with that PE house for 5 years, once a month. And if you don't get on with them, that's going to be an incredibly painful process to go through. So chemistry and getting on well and connecting well with the people in the room is definitely number one. I think references super important. Asking to see track record. So if a PE house is proposing to do a buy and build with your business, then asking to see other buy and build strategies that they've done and seeing how successful they've been is very crucial. I think asking about chairman candidates and the network that a PE house can bring. A lot of people will say, oh yeah, we've got a big network and we can introduce you to some people that will add value. Ask who, as you go through the process, definitely ask, well, who are you going to bring to the party, and will they really add value? Because it's a very easy thing to say, but the proof is in the pudding with that kind of thing. And the final piece I'd say is ask for a value creation plan. Like a lot of PE houses now are using value creation plans after their 100-day planning, once they get into a deal, and asking an investor really clearly how are you going to plan to add value to this business can be a really useful way of understanding how much is sales pitch and how much is actually going to add value to your business.
That's very useful. And of course, the conversation often, guys, is the other way around, isn't it? You guys are going, come on, tell us how we're going to grow this. What are your forecasts? What are your forecasts? So, there's a bit of reversing there, isn't there? In the, hang on a minute, I'm the one with the asset. What are you going to do to property develop it, guys? I got the land.
Yeah, to your point, it's all about teamwork. Like the most successful deals that we've done have been with a management team that we get on really well with, who know their industry inside out, have got a really strong growth forecast, and we come in and turbocharge that with our piece of value creation and capital. And when you get the right blend across the table of those elements, that really is the recipe for success.
Really good. Guys, I'm mindful of time. We're just sort of starting to overrun. I could always talk about this subject all day long. Whether it's trade or private equity, we fundamentally think that taking these exciting emerging mid-market businesses and figuring out the scale up is such an important part of the economy and such an important part of the entrepreneur's journey. So really passionate about making sure that all the right options are explored. And I know you two are as well. So that's been really helpful getting that feedback and insight, if you like, from the other side of the desk, and in really understanding it's not all about suits. People are approachable, so that's also key. I would like to say, to the extent where even on some of our transactions with private equity, we've rolled over some of our commission because we believed in the transaction so much. So that's maybe an important part of the alignment as well. But there's a lot of opportunity here if we can put aside that mistrust. I think trade, if you can create that we need motivation, and you just want to play golf, great. But actually, what are you going to do with your money? Let's examine this equation, because there are also some really exciting opportunities keep your business independent, and see where it can really get to with that next level of sort of institutional ownership. So anyway, I hope that's been useful. We will be sharing the webinar recording on the website, so you can push it out to colleagues, etc. Been too many questions in for us to answer them all, but we tried on some. So we will also share a Q&A answer. There's an article in our Leaderhead series that matches this webinar, Private Equity Myth versus Reality, which has got some of the tips. So, you know, there is a follow-on from this. And also we've got some other webinars coming up. You can see there on the screen. So love you to join us. Stay well, everybody. And thank you very much for listening. Really appreciate it.